If you sold your silver last week, I need you to sit down for this one because what just happened in the precious metals market is the kind of move that separates the people who understand cycles from the people who panic at the worst possible moment. I'm recording this right now because silver just surged over 9% in a single trading session. Gold jumped more than 4%. And this happened immediately after one of the most violent sell-offs we've seen in decades. Let me say that again so it sinks in. The same metal that crashed 32% and wiped out $2.5 trillion in value just came roaring back with a 9% single-day gain. Spot silver pushed above $86 an ounce. Gold climbed back toward $4,800. And if you weren't paying attention, you might have missed the entire reversal. Before we go any further, I need you to do something for me. If you're watching Financial Crux and you haven't subscribed yet, hit that button right now. I know everyone says that, but here's the reality. When markets move this fast, timing matters. And if you're not subscribed, you might not see the next video until after the move is already done. Also, I've left a link in the description to our WhatsApp community where I share real-time updates when things get crazy. And if you're on X, formerly Twitter, follow us there because when news breaks, that's the first place I post. Now let's get into what actually happened because the surface level story doesn't capture the full picture. The mainstream narrative is simple. Gold and silver sold off hard, then they bounced. End of story. But that narrative misses everything important. It misses the why behind the sell-off. It misses the mechanics of the bounce. And it misses what this price action is actually telling us about where we're headed next. Here's the framework I want you to keep in your head throughout this video. Markets don't move in straight lines. They move in cycles. And those cycles are designed, whether intentionally or just through human psychology, to inflict maximum pain on the maximum number of people. The people who bought at the top feel pain when it crashes. The people who sold during the crash feel pain when it bounces. And the only people who don't feel pain are the ones who understood the cycle from the beginning and positioned accordingly. So, let me walk you through exactly what happened step by step. The trigger for the recent sell-off was the nomination of Kevin Warsh as chairman of the U.S. Federal Reserve. Now, if you're not deep in the financial weeds, you might not know who Kevin Warsh is. He's a former Fed governor, a known hawk, and someone who markets interpret as potentially less accommodating than previous Fed chairs. When his nomination was announced, traders immediately started repricing expectations for future monetary policy. And here's the thing about gold and silver. They are incredibly sensitive to interest rate expectations. When traders think rates are going higher or staying higher for longer, they tend to sell precious metals because gold and silver don't pay interest. They just sit there. So, in a high-rate environment, the opportunity cost of holding metals feels higher. But here's the detail most people miss. The initial reaction to news is often wrong. Markets overshoot, traders panic, algorithms trigger cascading sell orders. And by the time the dust settles, prices have often moved far beyond what the actual news justified. That's exactly what happened here. The sell-off was violent, it was fast. It took silver down over 30% from its highs. It pushed gold to its lowest level in nearly a month, and it flushed out an enormous amount of leveraged long positions. But then something interesting happened. The bounce. Silver didn't just recover a little bit. It surged 9% in a single session. Gold jumped over 4%. And this wasn't a slow, grinding recovery. This was aggressive buying that came in hard and fast. Now, let me ask you a question, and I want you to really think about this. Who has the firepower to push silver up 9% in a single day? It's not retail traders. It's not small hedge funds. That kind of move requires serious capital. That kind of move suggests that big players were stepping in to buy what weaker hands were forced to sell during the crash. And here's the cliffhanger you need to understand. If the crash was designed to shake out weak hands, and if big money stepped in to buy the dip, then the people who sold at the bottom just handed their positions to the people who understand how this game works. Kyle Rada, a senior market analyst at Capital.com, made an interesting comment about the recent price action. He said it's reasonable that current prices are close to fair value given the irrational market behavior we've seen over several weeks. Now, I want you to parse that carefully. He's calling the recent price action irrational. He's suggesting that the extremes we saw both on the way up and on the way down were driven by emotion and speculation rather than fundamentals. And if that's true, then the current price might represent something like equilibrium. But here's my question. What does fair value even mean in a world where central banks are printing money, where debt levels are at historic highs, and where the entire financial system depends on continued confidence in paper promises? Fair value for gold isn't some fixed number you can calculate with a spreadsheet. Fair value for gold is whatever level reflects the market's trust in the monetary system. And when trust is shaking, fair value can move very fast in one direction. So when an analyst says we're at fair value, I hear that as we're at a level where the market is temporarily balanced. But temporary balance doesn't mean permanent stability. It means the next catalyst will determine whether we move higher or lower from here. Now let me give you some context on just how explosive the recent moves have been. Gold jumped 13% in January alone. That's the biggest monthly gain since November 2009. Think about that. We just saw the strongest January for gold in over 16 years. And silver did even better. Silver surged 19% in January, outpacing gold by a significant margin. These are not normal returns. These are not the kind of moves you see in quiet, boring markets. These are the kind of moves you see when something fundamental is shifting. And here's what I think is shifting. Confidence. Confidence in the dollar. Confidence in monetary policy. Confidence in the ability of governments to manage their debt loads without eventually resorting to inflation. When that confidence starts to crack, money flows into hard assets, and gold and silver are the hard assets that have survived every monetary crisis in human history. Now, let me talk about what's happening in the ETF market because this is where you can see retail sentiment playing out in real time. Silver ETFs absolutely exploded during the recent rally. The Mere Asset Silver ETF gained 9.44% in a single day. The HDFC Silver ETF climbed 8.68%. The Tata Silver ETF was up 7.52%. Across the board, silver ETFs posted gains that significantly outpaced their gold counterparts. But here's the number that should really get your attention. 1-year returns on silver ETFs are running between 250% and 278%. Let that sink in. If you had put money into a silver ETF 12 months ago, you would have more than tripled your investment. Gold ETFs posted strong returns too, but they were more measured. Daily gains in gold ETFs ranged from about 4 to 5%, and 1-year returns were approaching 100%, effectively doubling investor capital. Now, here's the pattern I want you to see. Silver moves faster than gold. Always has. When precious metals are rising, silver tends to outperform gold by a factor of 1.5 to 2 times. When precious metals are falling, silver tends to fall harder than gold by a similar ratio. And this is what traders call higher beta. Silver is more volatile. It's more emotional. It's more driven by speculation and momentum, and that creates both opportunity and risk. If you're right about the direction, silver will amplify your gains. If you're wrong, it will amplify your losses. That's the trade-off you accept when you choose silver over gold. Now, let me address something important because I want to give you balanced perspective, not just hype. Analysts at UBS have issued a caution about silver. They've said it's too early to build long-term exposure to silver, citing ongoing price fluctuations and heightened volatility. They're essentially saying that silver is too hot right now, too unpredictable, too risky for investors who want steady, reliable returns. And honestly, they have a point. Look at what we've seen in the past few weeks. Silver ran up to over $120 per ounce. Then it crashed 32% in a single session. Then it bounced 9% in a single session. That kind of volatility is not for the faint of heart. If you're someone who checks your portfolio every day and feels sick when you see red numbers, silver might not be the right asset for you. But here's the flip side of that caution. The biggest gains in any market come from the assets that are the most volatile. You don't double or triple your money by buying stable, boring investments. You do it by buying assets that have the potential for explosive moves and then having the stomach to hold through the volatility. So when UBS says it's too early to build long-term exposure, I hear that as an acknowledgement that silver is moving too fast for them to recommend with confidence. But that doesn't mean silver is a bad investment. It means it's a high-risk, high-reward investment that requires a specific kind of investor. Now let me add a layer to this analysis that I think is critical and often overlooked. Silver isn't just a precious metal, it's also an industrial metal. Gold sits in vaults. Gold sits in jewelry. Gold is held by central banks as a reserve asset. But silver gets used, it gets consumed, it gets embedded in products and often never comes back to market. Silver is critical for electronics. It's critical for medical equipment. It's critical for water purification. And perhaps most importantly, silver is absolutely essential for solar technology. Every solar panel requires silver. As the world pushes toward renewable energy and electrification, the industrial demand for silver is growing, not shrinking. This creates a fascinating dynamic. Silver has two sources of demand that can move independently: investment demand, which is driven by fear, inflation concerns and monetary policy, and industrial demand, which is driven by economic growth, technological adoption, and infrastructure spending. When both sources of demand are rising simultaneously, silver can experience the kind of explosive moves we've been seeing. But when they diverge, when investment demand is high, but industrial demand is weak, or vice versa, you can get choppy, confusing price action. Right now, I would argue that both sources of demand are supportive. Investment demand is clearly strong, as evidenced by the massive ETF inflows and the wild price swings. Industrial demand is also growing, driven by the global push for electrification and renewable energy. That's a bullish combination, but here's the risk. If the global economy slows significantly, if we get a real recession that crushes industrial activity, silver's industrial demand could fall even as investment demand rises. That would create conflicting forces on the price and could lead to more of the violent volatility we've been seeing. So when you think about silver, you need to think about both stories. The monetary story, which is about inflation, debt and trust, and paper money, and the industrial story, which is about economic growth and technological change. Both stories matter. Both stories affect price. Now, I want to talk about gold specifically because I don't want the focus on silver to overshadow what's happening with the anchor of the precious metals complex. Gold is doing exactly what gold is supposed to do. It's serving as a store of value in uncertain times. It's responding to monetary concerns, and it's holding up remarkably well despite all the volatility in the broader market. The fact that gold jumped 4% in a single session tells you something important. When the selling pressure lifted, buyers immediately stepped in. There was demand waiting in the wings. The dip got bought and prices recovered quickly. This is the behavior you see in a bull market. In a bear market, dips don't get bought, they get sold into. Prices grind lower over time with each bounce weaker than the last. That's not what we're seeing in gold. We're seeing strong dip buying, quick recoveries, and a general upward trajectory punctuated by sharp corrections. And remember, gold is up nearly 100% over the past year. That's an extraordinary return for an asset that's supposed to be safe and boring. When gold doubles in a year, it's telling you that something significant is happening in the monetary landscape. Central banks are buying gold aggressively. They've been accumulating for years, and the pace of accumulation has accelerated recently. Why would central banks who control the money supply and can print as much currency as they want be buying an ancient metal that pays no interest? The answer is simple. They're hedging. They're diversifying away from paper assets. They're preparing for a world where trust in fiat currencies might erode further. And if the people who run the monetary system are buying gold, maybe that's a signal worth paying attention to. Now, let me give you a practical framework for thinking about all of this. If you're trying to decide between gold and silver, here's how I would think about it. Gold is the anchor. Gold is the steady hand. Gold is what you hold when you want stability and long-term preservation of wealth. Gold moves with dignity. It doesn't spike 30% in a month and then crash 30% in a day. It grinds higher over time with occasional corrections that get bought. Silver is the accelerant. Silver is what you hold when you want exposure to the precious metals thesis, but you're willing to accept higher volatility in exchange for higher potential returns. Silver can triple in a year. It can also give back half of those gains in a week. That's the trade-off. Most people who are serious about precious metals hold both. They hold gold as the core position, the foundation, the thing they never worry about. And they hold silver as the opportunistic position, the thing that can add explosive returns if the cycle plays out the way they expect. The ratio between the two depends on your risk tolerance, your time horizon, and your conviction in the thesis. Someone who is very conservative might hold 80% gold and 20% silver. Someone who is more aggressive might flip that ratio. There's no right answer. There's only the answer that fits your situation. Now, let me talk about something that I think is really important, and this is where I want to add some independent thinking that you might not hear elsewhere. The volatility we're seeing in precious metals right now is not a bug, it's a feature. It's a feature of a market that is trying to re-prick in real time as new information comes in and as old assumptions get challenged. Think about what the market is trying to figure out. It's trying to figure out where interest rates are going. It's trying to figure out whether inflation is really under control or whether it's going to come back. It's trying to figure out whether central banks can manage their debt loads without eventually monetizing them. It's trying to figure out whether the global financial system can handle the stress that's building. Those are big questions. Those are questions that don't have easy answers. And as the market grapples with those questions, prices swing wildly as sentiment shifts from optimism to pessimism and back again. So, when you see silver crash 30% and then bounce 9%, you're not seeing random noise. You're seeing the market working through uncertainty. You're seeing traders and investors collectively trying to figure out what these metals are worth in a world that's changing fast. And here's the cliffhanger. The volatility isn't going to stop. As long as there's uncertainty about inflation, interest rates, and monetary policy, precious metals are going to keep swinging. That's not a reason to avoid them. That's a reason to position carefully and to have a plan for navigating the swings. Now, I want to address the people who are feeling regret right now. Maybe you sold during the crash. Maybe you got scared when you saw the 32% drop and decided to cut your losses. And now you're watching silver bounce 9% and you're feeling sick about it. I get it. That's a painful position to be in. But here's what I want you to understand. One trade doesn't define your investing career. One mistake doesn't mean you can't learn from it and do better next time. The lesson from this experience isn't that you should never sell. Sometimes selling is the right move. The lesson is that you should never sell in a panic. You should never make financial decisions when your heart is racing and your stomach is in knots. Those are the moments when you're most likely to do exactly the wrong thing. The people who sold at the bottom of this crash weren't thinking clearly. They were reacting emotionally. They were seeing red numbers and feeling fear and acting on that fear. And that's human. That's normal. But it's also expensive. So the next time you feel the urge to make a big move in your portfolio, stop, take a breath, wait until the emotion passes, and then ask yourself whether you're making a decision based on logic and strategy, or whether you're just reacting to fear. Now, let me shift gears and talk about what to watch going forward, because this story is far from over. First, watch the follow-through on this bounce. A single day of gains doesn't make a trend. What matters is whether prices can hold these levels and continue higher, or whether they roll over again. If silver can stay above $80 and push toward $90, that would be a strong signal that the worst of the selling is over. If it fails and drops back towards $70, the volatility continues. Second, watch the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive. Right now, silver has been outperforming gold, which suggests the ratio is falling. If that continues, it's a sign that risk appetite is returning and that traders are betting on the more volatile metal. Third, watch the ETF flows. The record inflows into silver ETFs in January were a major driver of the rally. If those inflows continue, there's fuel for higher prices. If investors start pulling money out, that fuel disappears. ETF flows are like a real-time sentiment indicator. They tell you what retail investors are actually doing with their money. Fourth, watch the Fed. The Wirsch nomination triggered this sell-off. Any further news about Fed policy, interest rate expectations, or monetary accommodation will move precious metals. The metals are basically betting that eventually central banks will be forced to ease again. Every piece of evidence that supports or contradicts that bet will show up in the price. Fifth, watch physical premiums. During the crash, physical silver in Shanghai was trading way above the paper price in the US. That divergence is important. It tells you that physical demand remained strong even while paper prices collapsed. If physical premiums stay elevated, it suggests that the paper market is not reflecting true supply and demand for actual metal. Now, let me give you some broader context because I think it helps to zoom out and see the bigger picture. We are in an extraordinary period in financial history. Debt levels globally are at all-time highs. Central banks have printed more money in the last few years than in the previous decades combined. Interest rates are elevated, but governments cannot afford to keep them high for long because their interest expenses are eating up ever larger portions of their budgets. Something has to give. Either debt gets paid down, which seems unlikely given political realities, or debt gets inflated away, which is the path of least resistance, or debt gets defaulted on, which would crash the system. If you believe that the most likely path is inflation, then gold and silver make sense as a hedge. They're assets that can't be printed. They're assets that have survived every currency crisis in history. They're assets that tend to rise when trust in paper money falls. That's the thesis. It's not complicated, but it requires patience, and it requires the ability to hold through volatility like what we just saw. Now, I want to talk directly to two groups of people watching this. If you've been holding gold and silver through all of this craziness, congratulations. You've survived a test that many people failed. You didn't panic. You didn't sell at the bottom. You held your conviction even when the market was screaming at you to give up. That takes discipline. That takes belief. And if this thesis plays out the way I think it might, you'll be rewarded for that discipline. If you've been on the sidelines watching all of this and you're wondering whether to get involved, here's my honest take. This is not a market for tourists. This is not a market for people who want steady, predictable returns. This is a market for people who have a thesis about the monetary system and are willing to bet on that thesis through thick and thin. If that sounds like you, then the recent pullback might represent an opportunity. Prices are lower than they were a few weeks ago. The panic sellers have been flushed out, and if the thesis is right, prices are going higher from here.